Hey guys, let's check out what we've got on StockTwits going on right now. Let's see what's trending. Wait, what the? XIV's trending? XIV's been gone for a year. What the? Let's take a look. Oh, I know why it's trending. It's been a year since the Volmageddon. Remember that, folks? Volmageddon? Wow, things have changed a lot in a year. Seems like it's been 10 years since then as far as volatility and volatility ETPs, doesn't it? Feels like so much has happened since then. That was a time of innocence when we all thought of volatility and the VIX ETPs being something that not that many people knew about. Some people thought it was easy money and it could never really spike, or if it did spike, then it was no problem. You just handle it, short some more, and it's going to go right back down. People were thinking that they could just make millions shorting UVXY, buying XIV. A lot of people had XIV as the main component of their investment portfolio. Well, a lot has changed since then, folks, for sure. And just want to say a moment of peace for XIV. That was a bad situation. I don't know if there's actually been a lawsuit or if that's gone anywhere against Credit Suisse. I know that what actually hurt my P&L more was actually when a couple weeks later UVXY decided to deleverage down from 2 times to 1.5 times. I was long a put spread in UVXY, and the value of the put spread like chopped in half, and it was very painful. And ProShares came out and made that adjustment out of the blue. They just said, "Oh, hey, we're just announcing we're changing our product fundamentally," and you happen to have an options position on that doesn't work for it. Well, just too bad. So that was not a pleasant time for me. It was not a pleasant time for my P&L. Fortunately, I did cover my position in UVXY ahead of the Volmageddon, so I didn't blow out. I didn't. Like I said, the aftermath was worse for me, having them adjust UVXY, than the actual Volmageddon day. Fortunately, I sidestepped it. I know a lot of people did get hurt, and for me personally, this was a wake-up call in that I know that I talk about these products all the time, and like it or not, people start to depend on me for accurate information and even for some sort of recommendation about this thing. Now, I am not a licensed financial advisor, and I always shy away and say, like, look, this is not financial advice, but I know that people watch, they're looking for information, they're looking for ideas, and they get them from me. And so even though, I did warn about the dangers of volatility trades, shorting volatility, and if we look through the videos, I had a specific video just about, it's called XIV and tail risk, and it warned specifically about the problems with XIV. It didn't really discuss what actually happened, which was basically a rebalancing liquidity type dry up thing. But it just said that this thing can rip, and you got to be careful for that. Careful of that. So I'm just going to try to pull this up as I'm talking to you here, that particular video. But safe to say, it was a bad situation, and a lot of people who follow me lost money. Now, I'm not culpable for them losing money. Everybody's an adult and makes their own decisions. I didn't make specific recommendations that you do something specific. I've just tried to clarify and educate people about volatility and VIX ETPs and how they work. And more than being a cheerer of people shorting volatility, I have been cautionary against people buying VIX ETPs as a way to get long volatility. I think I've spent more time actually doing that than recommending that anybody short anything. But this was a huge thing for our whole little space, the Vomageddon, and I'm happy to still be here after that time. It's amazing that the channel has prospered since then, and that there's people still in this space. We lost a lot of people in this space at that Vomageddon time, and some of them have never come back. A big portion of people have never come back. Some people are back, but they're very cautious, which makes sense. But it was the first time some people had seen a big event in their history as traders, because many people had started trading in the last 5 years, and the market had just sort of gone straight up a lot of the time, and they just had not even experienced that kind of a sell-off before. And so wake-up call to a lot of people. When somebody says, oh, well, X, Y, or Z could happen, be careful. It's different somebody saying, oh, this could happen, and it actually happening, and people being wiped out left and right. Some of the people that I've interviewed, I don't even know if they're trading still. One particular person I haven't heard from in a very long time. So as we look here, I think I'm getting there in my list of videos back to that day. I was fortunate to land Vance Harwood on the program on the day of the Vomageddon. So that was a very interesting interview to see. And I'm trying to find that right now as we speak. But XIV is gone. Other stuff is deleveraged, and we've talked about, well, will they come up with a new one of these things at some point? And the issue with that was that a lot of these banks did not want to underwrite this sort of product that could blow up in their face. But, this is a risk world. Okay, so here we go. Matt Thompson warns risks of XIV right before it crashes. That was a video where I talked about him having talked about it. Actually, that was the actual video. I just changed the title a little after. So that was Jan 28th of last year. And then, boom, the thing happened. And then we have huge vol spike, biggest day in volatility in years, play-by-play after hours, XIV, David Lincoln. So that was the day. And I know I was kind of flipping out, but once again, happy that I had covered my particular position. I was talking with Sal a lot and saying, like, as somebody who presents media online, what do I focus on most? Should I be focusing on providing the greatest content for the users? I'm sure some of you would vote for that one. Or should I be focusing on making money trading? And the thing is, you need to do both. People don't want to follow somebody who's not actually trading and who doesn't make money trading. And ultimately, financially, I want to make money trading, of course. So let's just pull up this video really quickly and see what some of it says with Vance from a year ago. And this is dated, let's see, February 6th. So this is on the Vomageddon. And let's see what he has to say. Let me move out of the way.
I think at that point the VIX was up about 75%, and the VXX was .iv. So that's a pretty good indication of the kind of standard index that a lot of these funds track. Really complex.
Is the
Right.
415 close. We did see SVXY, I believe, halt for a little bit at 407, which would still be technically in the open day for
Mm-hmm.
stuff. Um, but people were looking for some kind of indication in the futures for whether there had been an acceleration event in XIV, and the thought process for that. Anyways, that was us kind of recapping it minute by minute, a few hours after the halt, I believe, or that might have been right at the time of the halt, and that really kind of launched the channel. I mean, you hate to launch a channel about shorting volatility with an acceleration event in XIV, but I was lucky enough to land an interview with like one of the best known experts in the whole space on the day of XIV blow up. And so that was a huge thing for the channel. It kind of launched things and sort of put me on the map with a lot of people. So I'm grateful to Vance for that. He's always been very generous with his time and very supportive. All right, so yeah, we're trending in XIV right now, that being due to the fact that everybody is kind of reflecting on this Volmageddon anniversary thing. However, is the term structure that much different than before? It really isn't. We're kind of coming back to, we're in contango, kind of coming back. Some people may have thought it's never going to be the same. I think a lot of people thought that volatility was going to stay above 20 for like indefinitely. Some people were even saying that like we were going to stay in backwardation indefinitely and like UVXY was going to go straight up forever. Most people knew that that wasn't really even an option, and that just mathematically speaking, we would end up back in contango. In a sense, the system can only work if we are in a sort of contango situation, because obviously there's more risk to sell futures a month out than there is to sell futures a closer month in. A, B, we know that there's no way to directly arb out any discrepancy between the cash and the futures, and thus futures kind of act a little bit independently here. It's a unique product in that way. So right now we're looking at 2.46 contango coming into the weekend here, and that's about average. And expect, if we keep going sideways to up, expect that to continue to grow, because I don't see anything happening to stop that unless we get another big sell-off. Now, if you watched the interview I had with Sal Inungo a couple of days ago, he was very bearish on the market, and there are some that are very bearish on the market. I'm personally kind of indifferent on the market right now. I'm not super bearish. And as I said to him, I have a lot, just in cash, just to on the sidelines, because I am so indifferent, and would look to an opportunity to buy back in, some sort of sell-off or something. Let's take a look at some spreads. I was talking with somebody earlier today about spreads, call spreads. So I want to just talk for a second about what goes into thinking about putting on a call spread. My own thoughts about this have changed over time as well, and and one way it's changed is I'm more interested in risking a more equal amount for how much I'm collecting. So, for example, I used to be this huge fan of, selling something that had a 90% probability of success, but you were risking like $1,000 to make $80 or something. Because I just thought, look, there's almost no way that this is ever going to happen, so it's just free money. Basically what I was doing was I was looking at UVXY, and I was just selling naked calls that were way out of the money. So, for example, if we look at UVXY right now, the ETP's around 48. I was looking at something like going out to like April and selling like the April 125, or I'm sorry. Yeah, I was looking at selling the way out of the money call. So this thing's around 50. I was thinking about selling maybe the April 80 calls for like $1.60 and just sell those calls naked and just say, well, there's very unlikely that this thing's going to go from 50 back to 80. And if it does, maybe I can either cover a little bit on the way up or buy some shares against the calls I'm short on the way up. But basically, sell these calls and think of them as free money and forget them. But the Volmageddon and all that stuff made me think twice about that, because I said, well, the problem with that is that you have certain margin requirements. A, B, this thing can blow up in your face, and these calls, like for example, if I were to sell the 100 calls right here for let's say $1, this thing doesn't have to get to 100 for those calls to just explode in value. Now, if you have enough capital, the likelihood that this is going to be 100 or above on April expiration is very, very small. And it's showing a 10 delta. I would say it's even less than a 10% chance that this is above 100, at or above 100 on April expiration. But the problem is it's just not that efficient use of capital of all the things that there are to trade in the market to devote. You want to have a lot of cash on the sidelines so that you can weather the storm, because if it's just going to ruin it for you if this thing pops to 65 and you're forced to cover those calls when it's not even anywhere near them being in the money. But that could easily happen if you have a small account and you're selling too many calls. So I moved on to different strategies, which was selling call spreads, and that way you have a defined trade, defined risk. However, I was picking spreads that were, once again, very far out of the money. And if you're betting 1,000 to make 100, if it blows up on you, all of a sudden you've lost a bunch of money. And these things do tend to pop. And I was noticing that it would pop somewhat, and I would sort of panic and cover and end up covering for a loss, and it just wasn't working for me. And what I found to be more successful was to roll the strikes down a little bit. The opposite of selling way out of the money call spreads would be to buy way out of the money put spreads. So, for example, and I've talked about this sort of trade before, go out to July and buy UVXY, let's say with this around 50, buy the 40-35 put vertical in July. Or in June. You've got 100 days to go. Contango and stuff's going to pull this lower. You buy this put vertical, and if it gets there, you can more than double your money. But that is a bet that this is going to go significantly lower in the next, let's say, 6 months or so. A little less than that. Well, there's a happy medium between these two, of course, and that is trading sort of at the money-ish type stuff. Now, if we're in contango, then there is a certain edge to the downside. So if you're selling at the money calls that's showing a 50 delta on your sheets, they're actually a little bit less than a 50 delta when you take in the effects of contango pulling down. So I was, instead of looking at way out of the money call spreads that are fairly close to expiration, or way out of the money put spreads to buy that are very far from expiration, I've found sort of a happy medium, which would be to go out a couple months, maybe either March or April here, and look at an at the money spread. So, for example, UVXY 50, it would be something like, now it's very interesting in April that they have every strike here almost. I mean, it's like the 46, 47, 48, 49, 50. That's pretty bizarre to me that they have so many strikes represented here. But when we're trying to select a spread, I might pick a spread, something that was kind of like at the money in April. And this way, maybe you're betting 500 to make 500 or something. And therefore, the most it can blow up in your face is like, it's not like a 10-to-1 ratio. It's like a 1-to-1 ratio. And I feel better about that. So, for example, maybe April, 68 days to go, maybe sell the 48, 54 call vertical in UVXY. And that's kind of in the middle. It's like an at the money spread instead of a way out of the money spread. So sell the 48 call, buy the 54 call. And, in this case, it's kind of close to, bet one to make one. We're collecting well, this is more like 2 to 1, but collecting 200 and the risk is 400. So that's more like 2 to 1. But it's definitely closer than, selling the April 68 80 call vertical, where you're betting $1,000 to make 100. This kind of trade has the potential of blowing up in your face a lot more than one where you're betting 390 to make 200. So, the problem for me is I had a bunch of these blow up in my face, and I was unable emotionally to weather the storm. Like I said in my mind, I'm willing to risk X amount of money, but really the number that I was willing to risk before covering was a lot smaller. So, as is the case in a lot of things in trading, it's knowing yourself. If you've got, I don't know, $10,000 in your account, how much are you really willing to bet of that $10,000? Now, you might say, well, I'm willing to risk it all to trade, but if you lose $1,000 of that, are you all of a sudden going to reevaluate and say, I don't want to lose any more, I'm taking it off? Because that is not willing to risk it all. And for me, I recognized over time that I was more protective of the equity in my account than I was actually telling myself. So I would keep putting trades on, and when it came to actually weathering the risk, I wasn't willing to do it, and I covered for a loss a bunch of times, and that lost me money. So a lot of trading, once again, knowing yourself and knowing actually what you're willing to risk and willing to, because a lot of times with options trading, it's leaving the trade on for long enough for it to work. Stuff doesn't just happen overnight. Most of the time, you need to leave it on for the situation to change enough for the money to come into your account. Always remember that trading, for you to make money, somebody else has to lose it, and you need to be taking money from somebody else to make money, and that's just the way it works in the world, and it's not the easiest thing. So that's, for me, it's evolved with spreads. I look at a lot of these spreads as, because I'm doing these limited risk vertical spreads, I don't look at like buying one volatility versus another or that sort of thing very much. I look more as a risk reward ratio, or I'm looking at what's the most I can lose. And usually when I'm doing when I'm trading a vertical spread, I do have a directional bias one way or the other. I did make a video a couple days ago where it's a situation where you don't have a directional bias. You're just selling an out-of-the-money put spread or an out-of-the-money call spread based on the fact that the probability is in your favor. It's kind of like just, going to the casino, except the odds are in your favor a little bit, and spinning the wheel. And that can be an effective strategy for some sort of closer term options, like 2 weeks to go till expiration. You could pick an out-of-the-money put spread in, say, I don't know, Tesla or something, and put the trade on small and, make your little bit of money here and there and just be careful about which equities you pick and sell some small out of the money spreads or trades. And, that's a lot of the philosophy that is believed by like a Tasty Trade or a Option Alpha, is to get yourself into many high probability, small percentage of your account trades, and just use those probabilities in your favor over time to put together a decent living. There's other times though, and I many times I feel that verticals work the best when you actually do have a directional opinion or bias, and you can be as aggressive as your bias actually is, and you can cater spreads to that actual bias. A note on just trading in and out of spreads, I would never pay the offer. So, for example, let's look at Tilray for a second. If I wanted to sell a call spread in Tilray, let's say I was pretty bearish on the thing, wanted to sell the April 80-90 call spread. If I queue it up here, Okay, so the midpoint is 242. The bid's 55 cents, right? If we switch this to a buy, it's going to show the offer. So the market is 55-cent bid at 430. Okay, that's a very wide market, and that's certainly like discouraging. Obviously, it would be almost impossible to make money actually paying the offer or hitting the bid for this spread. They're very wide markets. Fortunately, the trade is mostly had somewhere around the midpoint. Now, you could watch this spread, this 80-90 spread during the day, and just based on just the markets moving around and stuff, this midpoint could switch around by like 50, 60, 80 cents, even a buck. So you want to watch it for a little bit and determine in your mind what you think it's worth. Now, one way of doing that is to check out the theoretical values based on whatever software you have. Probably has some sort of Black-Scholes model running. So, for example, this one on here has this spread. If I look at the two individual options, it has the 80 call worth $10, and the 90 call worth $7.58. So if you subtract 7.58 from 10, you get 2.42. So this software has this spread worth 2.42. So when I look at the market right now, if we go once again go back to that, buying the 80 call, selling the 90 call. I don't know what just happened to that. All right, so buying the 80 call and selling the 90 call. All right, so the mid-market is actually right around the theoretical value. What do we had at like 242 in this case? But it won't always be, because there could be some small book. Now, when I have the screen set up to look at theoretical value here, there's other ways you can set up your options screen, and I switch between them all the time. And I have this one set up that I have called Dave 1 that has the bid and offer sizes. So it's going to tell the market and it's going to tell the size. Remember, as a market maker, I was responsible to give a market and size for all trades. So I'm interested in the size here. So you see, for like April 90 calls here, these markets are incredibly wide, but it shows 670 bid at 845, won by 114. So it's possible if that's one there is just some resting order book. Now there could be some resting order book that's there for like a 1 or a 2 lot that's gonna take your midpoints way out of whack. So I wouldn't just rely on the midpoints. A. B, theoretical price is based on a Black-Scholes or similar model, and you want to know what components are going into this model. There's going to be volatility, there's going to be days till expiration, there's going to be any dividends, interest, all the components of the Black-Scholes model. Skew are going to go into this. Now, skew is obviously going to be part of volatility. And so this number isn't like, that's what it's worth. This is a modeling based on the inputs that you set up or that they've automatically set up that spits out this number. So I wouldn't take this as gospel. I would see where this number comes from. Now, sometimes what these programs will do is they will fit the theoretical numbers just to fit in between the two prices, and it'll like dynamically adjust your theoreticals just so it fits inside the markets there nicely. And so I'm a little suspicious of these theoretical numbers a little bit. But if you're going to be trading one of these spreads, you want to figure out what it's worth, what the markets are saying it's worth, what you think it's worth, and you want it to trade it somewhere around that point. If the midpoint of the market is 242, theoretical value has it worth 242, then depending on the liquidity, if it's a very liquid market, let's say this was Apple that's trading thousands and thousands of contracts a day, there's probably an inside market that's a pick'em market. And by pick'em, I mean whatever the theoretical value is, there's buyers and sellers on each side of that. So if you were to put a resting order as paying 242 for the spread or selling it at 242, your order would get filled pretty quickly because of the liquidity. However, something that's less liquid like Tilray, if this is worth 242, the price of entry into the trade might be that you've got to sell it down to 238 to get into the trade, and that's going to be just the way it is. And if I have conviction about a trade and I think it's going to work for me, many times, a couple bucks here or there to get in or out of the trade, it's still totally worth it, and that's the cost of doing business, and I understand that. Now, the outside market that was 55 cents bid at 430, of course, I'm not going to be willing to, sell this way, way less than what I think it's worth, or pay way, way, way more than I think it's worth if I was on the buy side. But there is an inside market, and you, depending on what time of the day it is, what's going on, if there's some big number, if unemployment or something is about to come out at 10 in the morning, they're going to widen the markets out for that. If, someone just declared war or something, they're going to widen the markets out. There's usually more liquidity, in the first hour of trading, and then in the last half hour of trading than there is other times of the day. Just if there's some big holiday, there's not liquidity. If it's middle of lunchtime, there's not liquidity. All these things will affect the liquidity of options, and is something to be aware of. You also, you might want to look, all right, so I'm going to go and check the open interest and see which strikes have the most open interest. Well, if I pull up this for Tilray, I can see, the 75 and 80 strikes have more open interest than a lot of these other ones. And, the 120 strike here has a lot of open interest. So probably there's going to be more liquidity in the strikes that have more open interest, right? And so when you're doing spreads, it's good to get to know your product. It's more complex than it seems, and it's kind of customized by product. But if you're looking at this stuff every day, and if you watch it, and if you trade, even if you trade just small, you're gonna get a feel for it over time and become an expert in your particular product. I just wanted to go to a second to barchart.com just to show you a way of finding some ideas. I was looking at this earlier today, and I just wanted to show you something here. I went under unusual activity for options, and this is going to show when they really want some sort of strike. So, for example, we were talking with Sal yesterday about trading commodities. Well, FCX is involved with, it's a mining company which I believe is involved with selling copper. And thus is a proxy for owning commodities. But that's not the one I was looking at. The one I wanted to talk about here is this MTB. I saw this one, MTB, and my criteria for these is that the stock has to be a decent price. It can't just be like a $5 stock. NTB is a $165 stock, and this one option usually has the open interest was 100, and there were 5,800 traded, and they're the January, February, March 15 strike of the 160 put, so pretty much at the money put in MTB, which is a bank. So then I went ahead and pulled up MTB. Let's investigate. All right, I'm interested in open interest, right? That's going to tell me if this is liquid enough at all for anything to happen. I'm interested in daily volume, so I can go to Analyze tab. The volume's, about 1 million shares last trading session, which is, enough volume to trade something. The February with 6 days to go, not a lot of options trade, doesn't look like. If I go under my Analyze tab here, though, I can check out option stats. So 19,000 options traded. So that sounds like enough volume to be able to trade something, especially for, us who are generally a little bit smaller traders. I look at my options time and sales. It's going to show me some trades. Options time and sales. Let's see. And when I go to options time and sales here, let me make sure you can see this. I'm standing in the way slightly. When I go to options time and sales here, if I go over to the right side of the screen, I can click on this thing. It looks like a little umbrella or something, and it's going to allow me to filter options time and sales. And I want to unclick everything if I want to see everything. So I just unclicked everything. Usually in Thinkorswim, now why is my head always in the way? Usually in Thinkorswim, they're going to show the top 2 trades of the last day. And it's showing these 150 lots here. We know, though, that there is unusual activity in that strike, and it was a 5,000 lot traded. So let's go to that strike. And we know it was in March, right? So let's just go to open interest in March here. So options chain, March. And I don't see it, so let's go back and look at. All right, so MTB put 165, January, February, March, 160 strike. MTB, March. All right, that's because I'm on straddle. Single options. All right, so under spread, we wanted single options. I was on straddle for some reason from another video. And we see, when we look at March for the open interest, we see that we had this strange looking volume here. We've got March 65 cost, 3,000 traded. March 70 cost, 3,000 traded. March 155 calls, 5,800 traded. March 60, 160 puts, 5,800 traded. So looks like put spread traded, looks like call spread traded here, right? Some sort of, looks like almost a risk collar. This big trade went up. So something's going to happen in March. This is a clue for us. And we can start to investigate this. We can't always figure out what happened, but we can make it a good attempt. So let's go to time and sales. And let's filter by just March options. So I'll go to series, and I'll select March. And we'll scroll down, and we should find these big trades. And it's interesting because you would think that it would be on the top of the screen as the biggest trade. So let's go to March, and we'll go to those puts. And it said the 160 strike. So we'll filter between the 155 and the 160 strike. And cruise down quickly here. All right, so what this is telling me is that that trade didn't get put on today. It got put on, or in the last session. It got put on a session before. A lot of times when stuff comes up on bar charts, it will be from, like a day before, a couple days before. So let's go back to March here, and we show the volume as being today though. So it's strange why it's not showing up on time and sales for March. Hold on. March 160 put. Now this might have been something like somebody recommended the spread, like for a newsletter or something, because it looks like from this all these small spreads coming up. So possibly a newsletter recommended this trade, or somebody online recommended this trade, and all these people are putting the spread on based on the recommendation, right? Something like that, because it's not a one big huge trade. It's several small trades of this spread. Can you see that? So obviously some sort of newsletter or somebody recommended that people put these trades on several small spreads, because we're seeing it over different times and different exchanges over and over again. And even it looks like a little bit different prices here. Let's see, the price was 307. Yeah, and a little bit different prices. So I hope this is just a guide for you to how to investigate something and get ideas. Learn to use, if you use Thinkorswim, and I would recommend checking out Thinkorswim because I think it's a great product and it's really powerful. Learn to use Thinkorswim and analyze stuff. Learn to look up in a stock what's going on. Time and sales is like one of the most key things for me as a trader, to find out what's going on, what's happened recently. Are they buying or selling? I was used to standing in a pit where you had access to all the information. You can't get as much information at home, but you can get a lot of it. And you can't always tell from an options trader who's on the buy side, who's on the sell side, or what they're doing. But a lot of times you can get some decent information. If someone's coming in and paying the offer in an option, then that means there's buyers out there of that option. If volatility is 100 today and tomorrow it's 120, then obviously there's buyers. You might want to take a notebook, write down what's volatility today, what was it a week ago. There's tons and tons of stuff on Thinkorswim that I don't even know about that are powerful tools to help you. But familiarize yourself with some of the most basic ones and get out there. There's thousands of stocks out there, and look at stuff, and I'm sure you can generate some ideas for yourself. I'm here to help. Please reach out to me for help, and let's work on this stuff together and make some money. There's, the best way for you to make money is to come up with some ideas and try some stuff. Following some guru and going out there and paying someone a bunch of money is not the way you make money. That's the way you lose money. Going out there, doing some research and figuring out some stuff and trying some stuff is the way you get started to make money. I heard some guy on StockTwits saying, I wish I could afford this $200 a month to be in this chat room with these people. We're not necessarily here to make friends and chat with people. We're here to make money. I do this video gaming thing where all these gamers are on there and they spend all this time gaming. I don't necessarily want to spend all my time gaming. I want to spend time figuring out how to make money so I can have freedom and the lifestyle I choose. Thanks for watching again today, folks, and I hope I gave you some ideas. These videos are not, it's not all about beautiful artwork in video. It's about figuring out stuff and making and getting ideas so that you can make money. So if I can give you one idea that helps you as a trader from this video, then I've succeeded. And I'll see you in the next one.
Rescue teams have suspended their search for survivors of Friday's mining dam collapse